Hello trader, welcome back to the Forex gig. In today's video we are going to be discussing the Heiken Ashi Scalping Strategy, a method that can enhance your trading strategy and trading experience. This strategy utilizes the Heiken Ashi candlestick pattern to help you identify market trends and make informed decisions quickly. By the end of this video, you will understand how to effectively apply this strategy to your trading routine, including essential tips for managing risks. Make sure to watch until the end of this video to gain valuable insights that can assist you in your trading journey. So what do we understand by the Heiken Ashi candlestick chart? The Heiken Ashi candlestick charts are unique tools used in Forex trading that help you analyze chart movements. Unlike your traditional candlestick, unlike this this normal candlestick, the Heiken Ashi candlestick pattern is designed to filter out the market noise and provide a clearer view of trends. This makes them particularly useful for traders who want to make quick decisions such as scalpers. The key difference between the Heiken Ashi and standard candlestick charts, the key difference is it lies in how the candlesticks are calculated. Each Heiken candlestick chart uses a formula that averages price over a specific period. The open price of a Heiken cash candle is calculated at the average of the open and close price of the previous candle. The close price is determined by the average of the high, low, and open and close price of the current period. I take that again. The close price of this candle is determined by the average, is by averaging the open, the high, the low, and the close price of the current period. This method smoothens the appearance on the chart. As you can see from the chart, this is the Heiken chart. When you look at the Heiken chart, you will notice that during an uptrend, the candles are typically green and have little to no lower shadow. As you can see, little to no lower shadow at all. This indicates strong buying pressure. You can see that the green candles indicates an uptrend with minimal low shadow. This visual representation makes it clear that buyers are in control of the market. The design of the Heiken chart helps traders to avoid false signals that occur in volatile markets by filtering out some noise. This chart allows you to make more informed trading decisions based on a clearer signal on the chart. Conversely, during a downtrend, you will see series of red candles with absence of shadow. You wouldn't see an upper shadow. You see red candles with no upper body shadow. This is an example of what I'm trying to say. Strong selling signal pressure. The absence of shadow reinforces the strength of the trend. When you see a downtrend, let's look for another example of a strong downtrend. When we see an example like here, as we can see, price was trending to the downside, and we can see there is little or no upper shadow when price was trending to the downside. So let's see how we can implement the Heiken Ashi Scalping Strategy. Let's see how we can implement this strategy. To implement the Heiken Ashi Scalping Strategy, it involves several key steps that could help you make informed trading decisions. This strategy focuses on identifying entries and exit points based on the signal provided by the Heiken Ashi candlestick. To enter and exit points, to start, you need to identify the right entry point. You have to look for pullbacks in trend. As you can see, this trend is trending to the upside, and we have to look out for pullbacks. When we observe these pullbacks, when you see a series of green candle, of green Heiken ash candles in an uptrend, wait for a red candle to appear signaling potential pullback. As you can see, the red candle appear signaling potential pullback. This is your opportunity to enter the trade when the next green candle forms. So you enter the moment you see the next green candle. As we can see from this area, you enter once the next green candle presents itself, indicating buyers are regaining strength and regaining control. So we enter at this particular place in the market. You can see another example from here when we see series of bearish candles, bearish Heiken chart candles. The moment we see a green candle to the upside means that buyers are regaining strength in the market and will enter a trade as the case may be. In this chart, you can see how the appearance of the red candle during the uptrend is followed by a green candle. This confirms that the trend is continuing, providing a good entry point for your trade. For exit, consider taking profit at key levels. You can take profit at key levels like previous highs or lows, or we can use psychological levels. You can also use resistance levels as exit points. If you are in an uptrend and you see multiple green candles looking for signs of weakening momentum, such as a red candle appearing after series of green candle, you can take your trade the moment you see signs of rejection and you see a green candle forming after series of green candles. You exit your trade in that area. We also need to effectively add our risk management to this our trading strategy, because risk management is crucial when implemented in any strategy. With the Heiken Ashi Scalping Strategy, setting stop loss order is effective. It's essential to protect your capital. Place a stop loss just below the last swing low in an uptrend. Then in a buy trend, if you have to take a buy trend trade, the moment we see an exhaustion in price in a downtrend after seeing series of bearish Heiken ash candles and you see a sign of retracement, the moment we see that our chart is forming back our series of bearish Heiken chart candles, we enter the trade in that area. We put our stop loss just below the swing low of that area. We can put it just below any swing low in that area to give the room enough breathing space, and this will help you to minimize your potential losses if the market moves against you. Additionally, consider using a risk to reward ratio at least 1:2 when taking profit. You can take profit using 1:2 risk to reward instead of using the other method we talked about, like waiting for a reversed candle to show in the direction of your trade. You can actually take your profits by targeting 1:3 or 1:2 as the case may be, because this means that for every dollar you risk, it aims to make at least $2 in profit. That's what 1:2 means. This approach helps you ensure that even if some trades do not work out well, your overall trading results remains positive. Alright traders, we have come to the end of this video. If you found this video helpful, please like and subscribe to the channel, and do not forget to turn on the notification bell so that you wouldn't miss out on future content. Thank you for tuning in, and until next time, happy trading.